Fictional stories are entertaining, keep us occupied, and allow us to unwind from the constant onslaught of reality. But what if fiction was being presented to us as the truth? Some would be unable to separate fact from fiction. True words would be unrecognizable, blending in with fairy tales. Today we experience this with the official figures of unemployment, inflation, and of course my favorite, the stock market. Remember to tune in to financial websites daily because laughter is the best medicine. You came here for the truth, so let me unveil that for you. Today we are going to talk about, among other things, MarketWatch saying that the stock market could fall as much as 5,000 points. We'll get into that in a moment. Just wanted to look at the markets here. Let's begin with that bit of humor. Japanese stocks jump most in 4 months amid stimulus signals. That's right. They're doing well right now as of this recording. And you could see the other stock markets there going across the middle of the page. The Dow Jones, the S&P, and so on all have done well. All in the green. Now, why are they doing well? What fundamentally has changed? Absolutely nothing. But we've seen through 2016, they really haven't done so well overall. I'll get into that in a moment. I'll show you the chart. Let's look at this first. The European Central Bank remains on a path of easy money, but disappointed markets in December, not being as aggressive as expected in its latest decision on interest rates and bond purchases. So you didn't print enough money. You will print money. You are printing money. You promise to print more money into the future, but it's not enough for us. So it's not about actually getting unemployment rates to decline, finding jobs for people, and getting the economy moving. It's about how much money you are willing to print. And this goes for the ECB, goes for the Fed. Officials at both the ECB and the Fed have expected stabilization in oil prices to help them boost inflation back to the desired ranges of about 2%. I want to get into my opinion on oil, something that I really haven't talked about yet, but I'll save that for a little while here. Just wanted to get into a couple of these articles first. The biggest risk for China is not to slow down in a measured way, but to stimulate the economy to such an unrealistic speed that it implodes suddenly and goes down in flames. That's right. You have to balance it out. Yes, you want to print money. Yes, you want to reduce interest rates. Yes, you want to loosen the lending standards, but don't do it too much because then you're going to break things. Well, this is just absurd, the way that they talk about this every single day. This right here is 2016 as we see a few of the major markets around the world declining significant numbers, a heavy drop downward, and we're not even through the month of January yet. This could definitely change. It could be just January that's like this, and I don't really have a reason why they would go up though from this point here. Yes, there are daily price fluctuations. Things happen like this. However, I don't see it necessarily working good over the next little while without some boost from central banks or some sort of stimulus or TARP type bailout. Let's look at this. The jobless claims jump to a 7-month high. That's significant. Now, usually what happens in these cases is, it's a cycle that repeats. They hire a whole bunch of temporary workers. Whether it's for census workers or anything else, they get laid off. So then the jobless claims will go up. But what do? They rehire the temporary workers back, and it looks like they have basically been able to achieve a lot more work, but it was the same people that were laid off the month prior. A very, very simple game that they play. It's been going on for quite some time, and it will continue on into the future. Now, this is the article that we're going to talk about here. This is not my opinion. This is MarketWatch talking about this, and they do have some very good information in here. Hard to believe that the Dow Jones could fall by another 1,000 to 5,000 points and still not be quote-unquote cheap compared with the long-term stock valuation measures. There's too much to get to in this article here. I'm just going to cover a couple points which I believe are very important. That's the stark conclusion from an analysis comparing current stock prices to the underlying measures such as per share revenue, earnings, and corporate net worth. So we're not just looking at the price itself, but we're looking at these other measures with the per share revenue, earnings, and the corporate net worth. Basically, they're overdue for a short-term bounce or a rally of some kind. Buying heavily into the latest sell-off isn't the kind of one-way bet that value investors crave. And small company stocks are now deep in a bear market after falling more than 20% from last spring's highs. What I would suggest to you is that this isn't the way it works. As I've said many times before, you don't look at small caps as one group and think that, okay, I'll just invest in small caps since it's down 20%. I don't think that's how this is going to work at all. I do believe that there will be some heavy manipulation, whether that's buying shares directly, whether that's an introduction to QE4, whether that's more of the central banks around the world buying up shares of the stock markets. Even after the sell-off, U.S. stocks are valued around 1.4 times the annual per share revenue. FactSet says that the average since 2001, when it began tracking the data, is 1.3 times the revenue. So the Dow could fall another 7% or over 1,000 points and still be no lower than its modern day average. We have a lot to go here in this terms. Will the stock market decline by 1,000? Will it decline by 5,000? In fact, I think it's likely that we could see real deflation. But as soon as the central banks, like the Fed, see real deflation, they will react and they will print money, and they will do so, and they will cause a hyperinflation if necessary. They will not allow deflation to take hold. They will allow it to, basically happen for a period of time, but they will not let it go for an extended period. They will hyperinflate the currency if necessary. This right here is a connected chart. Cheaper but not cheap. Value of U.S. companies' total equity and debts as a multiple of annual revenues. What I'm trying to show here is that there is a long way to go. Look at it during the financial crisis, and if it's even equally as bad as it was back then, it still has a lot to drop in this regard. Let's move on to what I wrote about in my book. Basically talking in this chapter here about debt. The lowering of interest rates is really just a crutch for the system. The most recent recession saw interest rates drop to their lowest in history. Never before has money been borrowed so easily. The paradox is that we're in this terrible position today because of the debt we have accumulated. What is their intention? It is to print money, to engage in deficit spending, a program which has never successfully worked. Now, let's talk about oil. Crashing oil prices decimate Texas boom towns. This is just one area of the world which is being affected by the price of oil. I've gotten to this quite a bit recently. What I just wanted to suggest about oil is that if the price of oil comes down, being it such a very important commodity in today's world, why wouldn't that boost the economy? Think about that for a second. You have oil being used for transportation and all kinds of products, yet the price of it going down significantly, many multiples from its peak, has not boosted the economy. Gasoline has gone down, but we have seen people spending more now. Obamacare has really filled in the gaps on that one. So why exactly has it not caused a boost? Well, this is a topsy-turvy world and nothing at all makes sense. But what does make sense to me is giving CEO bonuses and increasing the salary of the CEOs. This to me is very important, and I think all CEOs should receive a direct grant from the taxpayer at the rate of $1 zillion per year. Even as Wall Street braces for more cuts to jobs and bonuses, JPMorgan Chase CEO Jamie Dimon was paid $27 million in 2015, up from $20 million the year before. Excellent. He has a raise, and he's done well for the company, obviously, because they've avoided a lot of the criminality which they have been accused of. So he's obviously doing something right. That's all I wanted to get to for this video. We can see what's happening. We're being force-fed fiction. It's trying to pass itself off as truth, and I personally am not having it. If you found this video informative, please give me a thumbs up. Last but not least, if you go over to Amazon, they have a look inside feature, which allows you to flip through the pages of the book and see if you like it. Take care.